If you're watching this video, you probably want to get rich. But here's what Warren Buffett would tell you right now. You're thinking about it all wrong. While everyone's chasing crypto moonshots and day trading get-rich-quick schemes, the Oracle of Omaha has been quietly using the same boring strategy for over 60 years to build a fortune worth over $100 billion. And today, I'm going to break down his exact method, the one that turned a paperboy from Nebraska into one of the richest people on earth. This isn't about picking stocks or timing markets. This is about a fundamental shift in how you think about money, time, and wealth building that you can start implementing today, even if you're completely broke. We're going to cover 3 game-changing principles that Buffett has used consistently since he was your age. First, the compound interest mindset that most people completely misunderstand. Second, the boring investment strategy that beats 99% of professional fund managers. And third, this is the most important one, the wealth-building habits you can start today with whatever money you have, even if it's just $50. By the end of this video, you'll have a complete blueprint for building lasting wealth the Warren Buffett way. Let me start with a story that will change how you think about money forever. When Warren Buffett was 11 years old, he bought his first stock. 3 shares of Citi Service Preferred for $27, and young Warren was terrified. But instead of selling, he held on. When it bounced back to 5, here's the kicker. If Warren had held those shares, they would have been worth over $400 each just a few years later. That early lesson taught him something that most people never learn. The real money isn't made in the buying and selling, it's made in the waiting. But here's where it gets really interesting. Buffett didn't just learn about patience that day. He discovered what Albert Einstein allegedly called the 8th wonder of the world, compound interest. And this is where most people get it completely wrong. When people hear compound interest, they think about bank accounts earning 2% a year. Boring, right? But Buffett thinks about compound interest differently. He thinks about it as the most powerful force in wealth building, and he's proven it over 6 decades. Let me show you exactly what I mean with some numbers that will blow your mind. If you invested $36 million today, that's not a typo. $36 million from a $1,000 investment. That's the power of compound growth over time. But here's what's even more incredible. Buffett achieved this with an average annual return of about 20%. Not 200%, not 2,000%, just 20% per year, consistently, for decades. While day traders are trying to make 20% in a day, Buffett was making 20% per year and letting time do the heavy lifting. Now you might be thinking, that's great for Buffett, but I don't have decades to wait. But here's the beautiful thing about compound interest. It works at every level and every time frame. Even if you're starting with small amounts, even if you're starting later in life, the principles remain the same. Let me give you a practical example. If you're 25 years old and you invest just $1.1 million, if you start at 35, you'll have about $150,000. The key insight here is that time is more important than the amount you start with. Buffett started investing when he was 11, but even if you're starting at 25, 35, or 45, you still have the power of compound growth on your side. Now let's talk about how Buffett actually invests. And I'm warning you right now, this is going to sound incredibly boring compared to what you see on social media. There are no crypto trades, no options plays, no technical analysis charts. What Buffett does is so simple that most people dismiss it as too easy to work. Here's his entire investment philosophy in one sentence. Buy wonderful companies at fair prices and hold them forever. That's it. No day trading, no market timing, no complex derivatives. Just buying great businesses and becoming a long-term owner. But what makes a wonderful company in Buffett's eyes? He looks for what he calls economic moats, competitive advantages that protect a business from competitors. Think about Coca-Cola, one of Buffett's most famous investments. What's Coke's moat? Brand recognition. There are thousands of cola drinks, but there's only one Coca-Cola. That brand recognition allows them to charge premium prices and maintain market share year after year. Or consider Apple, which became Berkshire Hathaway's largest holding. Apple's moat isn't just their technology, it's their ecosystem. Once you're locked into the iPhone, iPad, Mac ecosystem, switching to competitors becomes incredibly difficult and expensive. That's a powerful moat. Here's where this gets practical for you as a beginner. You don't need to analyze complex financial statements or understand advanced valuation metrics. You can start by investing in what Buffett calls index funds, specifically low-cost index funds that track the entire stock market. In fact, Buffett has said repeatedly that for most people, a simple S&P 500 index fund is the best investment they can make. He's so confident in this strategy that he made a famous bet in 2007. He wagered $1 million that a simple S&P 500 index fund would outperform a collection of hedge funds over 10 years. The hedge funds had teams of PhDs, complex algorithms, and billions in resources. The index fund was just a boring fund that bought all 500 companies in the S&P 500. Guess who won? The boring index fund beat the hedge funds by a huge margin. While the hedge funds returned about 2.2% annually after fees, the S&P 500 index fund returned 7.1% annually. That might not sound like a huge difference, but over 10 years, it meant the difference between doubling your money and barely keeping up with inflation. This is what Buffett means when he talks about the boring truth about getting rich. The most effective strategy isn't exciting. It doesn't make for good social media content. You can't brag about it at parties. But it works consistently over time. Here's how you can implement this strategy starting today. Open an account with a low-cost brokerage like Vanguard, Fidelity, or Schwab. Look for an S&P 500 index fund with an expense ratio below 0.1%. That means you're paying less than $1,000 invested. Set up automatic investments so money goes into this fund every month, regardless of what the market is doing. That's it. You're now investing like Warren Buffett recommends for beginners. No stock picking required, no market timing needed, no complex analysis. Just consistent, automatic investing in the broad market. But here's where most people get stuck. They understand the theory of compound interest. They know about index funds, but they can't figure out how to actually start building wealth with their current income. This is where Buffett's personal habits become incredibly valuable. Warren Buffett still lives in the same house he bought in 1958 for $100 billion, but he lives like someone worth $100,000. This isn't about being cheap, it's about understanding the difference between spending money and investing money. Here's the mindset shift that changed everything for Buffett, and it can change everything for you too. Every dollar you spend today is a dollar that can't compound for the next 10, 20, or 30 years. When Buffett sees a 5, he sees what that 5 becomes about 5 coffee habit becomes a $32,000 opportunity cost over 30 years. Now I'm not saying you should never buy coffee or enjoy your money, but Buffett's approach is to be incredibly intentional about spending. He spends money on things that truly matter to him and ruthlessly cuts expenses on things that don't. Let me give you a practical framework for implementing this. Buffett divides all expenses into 3 categories: needs, wants, and investments in yourself. Needs are things like housing, food, transportation, and basic health care. Wants are everything else: entertainment, dining out, new clothes, gadgets. Investments in yourself are things like education, books, courses, or tools that can increase your earning power. Here's how to apply this framework starting today. First, track every expense for 1 month. Don't judge. Don't change anything yet. Just track. Use an app like Mint or YNAB, or even just a simple spreadsheet. At the end of the month, categorize every expense as a need, want, or investment in yourself. Most people are shocked by what they discover. The average American spends over $1,800 on coffee and beverages, and $6,000 per year on things that provide temporary pleasure but no long-term value. Now, here's the Buffett approach. Take 50% of your want spending and redirect it to investments. If you're spending $250 to your index fund, that's $493,000 over 30 years. But here's the really powerful part. Use the other 50% of your want spending more intentionally. Instead of mindless spending, choose experiences and purchases that truly add value to your life. You'll actually enjoy your money more because you're being deliberate about it. The second habit is what Buffett calls paying yourself first. Before you pay any bills, before you spend money on anything else, invest a fixed percentage of your income. Buffett recommends starting with at least 10%, but even 5% is better than nothing. The key is to make it automatic so you don't have to rely on willpower or remember to do it. Set up an automatic transfer from your checking account to your investment account on the same day you get paid. Treat this like a non-negotiable bill. You wouldn't skip your rent payment, so don't skip your investment payment to yourself. Now we need to talk about the biggest obstacle to building wealth the Buffett way, your own psychology. Everything I've shared so far is simple, but simple doesn't mean easy. The hardest part about getting rich slowly is the slowly part. We live in a culture of instant gratification. Social media shows us people getting rich overnight with crypto, day trading, or business ventures. Meanwhile, Buffett's approach requires you to invest money and then wait for years, for decades. That's psychologically challenging for most people. Buffett has talked extensively about what he calls Mr. Market, his metaphor for the emotional, irrational behavior of stock prices in the short term. Some days Mr. Market is euphoric and willing to pay crazy high prices for stocks. Other days, he's depressed and wants to sell everything at bargain prices. The key to successful investing is to ignore market's mood swings and focus on the long-term value of the businesses you own. But here's what's really interesting. This same psychology applies to your personal wealth-building journey. Some months, you'll be excited about investing and want to put in extra money. Other months, you'll see your account balance drop and want to stop investing altogether. The key is to ignore these emotional swings and stick to your systematic approach. Let me share a story that illustrates this perfectly. During the 2008 financial crisis, when the stock market crashed and everyone was panicking, Buffett wrote an op-ed in the New York Times titled, "Buy American." I am. While everyone else was selling in fear, Buffett was buying. He understood that market crashes are temporary, but great businesses recover and continue growing over time. If you had invested $10,000 in an S&P 500 index fund at the worst possible time right before the 2008 crash, you would have lost about 50% of your money in the first year. Terrifying, right? But if you held on and continued investing, that $10,000 would be worth over $35,000 today. The people who panicked and sold at the bottom locked in their losses. The people who stayed the course and kept investing got rich. This is why Buffett emphasizes the importance of having the right temperament for investing. It's not about being smart or having access to special information. It's about being able to think long-term when everyone around you is thinking short-term. Here's a practical technique for developing this mindset. Every time you check your investment account balance, and Buffett recommends doing this as infrequently as possible, ask yourself this question. Am I planning to sell these investments in the next 5 years? If the answer is no, then the current balance doesn't matter. What matters is that you're consistently adding to your investments and the underlying businesses are continuing to grow. Another psychological trick Buffett uses is to think of himself as a business owner, not a stock trader. When you buy shares of an S&P 500 index fund, you're not buying pieces of paper that fluctuate in price. You're buying tiny pieces of 500 of the best businesses in America. You're becoming a part owner of companies like Apple, Microsoft, Amazon, and Google. These companies have millions of employees working every day to grow their businesses and increase their profits. As a shareholder, you benefit from all that work without having to do anything except hold your shares. Once you've mastered the basics, automatic investing, living below your means, thinking long-term, it's time to scale up your wealth-building machine. This is where Buffett's approach becomes really powerful, because the same principles that work with small amounts work with large amounts. The first way to scale up is to increase your savings rate over time. Buffett recommends what he calls lifestyle inflation resistance. As your income grows, resist the temptation to increase your spending proportionally. Instead, direct most of your raises and bonuses toward investments. Here's a specific strategy. Every time you get a raise, immediately increase your automatic investment by half of the raise amount. If you get a 100, this way, you still get to enjoy some lifestyle improvement, but you're also dramatically accelerating your wealth building. Let me show you how powerful this can be with real numbers. Let's say you start at age 25, investing $430 per month. By age 45, you're investing about $890 per month. With this approach, assuming 10% annual returns, you'd have about $300 per month for 40 years without any increases. They'd have about $1.2 million, just from gradually increasing your investment rate as your income grows. The second way to scale up is to focus on increasing your earning power. Buffett is famous for saying that the best investment you can make is in yourself. Unlike stocks or bonds, no one can take away your skills, knowledge, and abilities. This doesn't necessarily mean going back to school for an expensive degree. It means continuously learning skills that make you more valuable in the marketplace. Read books, take online courses, attend workshops, find mentors. Buffett himself reads for several hours every day and has said that knowledge compounds just like money. Here's a practical approach. Dedicate at least 1 hour per day to learning something that could increase your earning power. This might be learning a new software program, studying your industry, developing leadership skills, or even learning about investing and personal finance. 1 hour per day is about 365 hours per year, equivalent to more than 9 weeks of full-time work dedicated to self-improvement. The third way to scale up is to eventually move beyond index funds to individual stock investing, but only after you've mastered the basics. Buffett didn't start with individual stocks. He started with the fundamentals of saving, investing, and thinking long-term. Only after he had a solid foundation did he begin analyzing individual companies. If you want to eventually pick individual stocks like Buffett, start by studying his approach. Read his annual letters to Berkshire Hathaway shareholders. They're available free online and are considered some of the best investment education you can get. Study the companies that Berkshire owns and try to understand why Buffett invested in them. But here's the important part. Don't stop your index fund investing to start picking stocks. Add individual stock picking as a small percentage of your portfolio, maybe 5% to 10%, while keeping the majority in low-cost index funds. This way, you can learn and experiment without risking your financial future. Now let's talk about the mistakes that can derail your wealth-building journey. Buffett has seen every possible investment mistake over his 60-plus-year career, and he's learned to avoid them. More importantly, he's learned to help others avoid them too. The first major mistake is what Buffett calls activity for activity's sake. This is the belief that you need to constantly buy and sell investments to make money. The financial media promotes this idea because it generates clicks and commissions, but it's wealth-destroying for individual investors. Studies consistently show that the more frequently people trade, the worse their returns become. The average individual investor earns about 4% per year, while the stock market averages about 10% per year. The difference is almost entirely due to bad timing, buying high when they're excited and selling low when they're scared. Buffett's approach is the opposite. Our favorite holding period is forever. He's held some stocks for decades. through multiple market crashes, recessions, and boom cycles. This isn't because he's stubborn or lazy. It's because he understands that great businesses compound wealth over time, and frequent trading interrupts that compounding. The second major mistake is trying to time the market. This is the belief that you can predict when stocks will go up or down and adjust your investing accordingly. It sounds logical, but it's nearly impossible to do consistently. Buffett has a famous quote about market timing. "I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. He invests based on the long-term prospects of businesses, not on short-term market predictions. Here's why market timing doesn't work. You have to be right twice. You have to correctly predict when to sell, and you have to correctly predict when to buy back in. Miss either timing decision, and you can seriously damage your returns. Consider this. If you missed just the 10 best days in the stock market over the past 20 years, your returns would be cut in half. The problem is that the best days often come right after the worst days, when everyone is most pessimistic and least likely to be invested. The third major mistake is letting emotions drive investment decisions. Fear and greed are the two emotions that destroy more wealth than any market crash or economic recession. When markets are going up and everyone is making money, greed kicks in and people start taking bigger risks, buying speculative investments, and abandoning their disciplined approach. When markets are going down and everyone is losing money, fear kicks in and people sell their investments at exactly the wrong time. Buffett's solution is to have a systematic approach that removes emotion from the equation. Automatic investing, predetermined asset allocation, and a long-term mindset help you stay disciplined when emotions are running high. The fourth mistake is not understanding the impact of fees and taxes. These might seem like small details, but they can cost you hundreds of thousands of dollars over a lifetime of investing. High-fee mutual funds and frequent trading can easily cost you 2 to 3% per year in fees and taxes. That might not sound like much, but over 30 years, it's the difference between having 1.8 million. Buffett consistently recommends low-cost index funds, precisely because they minimize these wealth-destroying fees. The fifth mistake is not having a written investment plan. Without a plan, you're likely to make emotional decisions, chase performance, and abandon your strategy at the worst possible times. Your investment plan doesn't need to be complicated. It should answer these basic questions. How much will you invest each month? What will you invest in? Under what circumstances will you change your strategy? How often will you review your progress? Write down your plan and review it annually. When market volatility makes you want to change course, refer back to your written plan and remind yourself why you chose this approach. Here's something most people miss about Warren Buffett's approach. The principles that make you wealthy also make you successful in every other area of life. Buffett doesn't just apply compound thinking to money. He applies it to relationships, knowledge, health, and personal development. Take reading, for example. Buffett reads for several hours every day and has done so for decades. He's not reading to get rich quick or find the next hot stock tip. He's reading to continuously compound his knowledge. Each book builds on the previous ones, creating a vast network of understanding that gives him an advantage in business and investing. You could apply this same approach to your career. Instead of job hopping for short-term salary increases, focus on building compound skills that become more valuable over time. Learn to communicate better, develop leadership abilities, understand technology, build relationships. These skills compound just like money. Each improvement builds on the previous ones. The same principle applies to relationships. Buffett has maintained many of the same friendships and business partnerships for decades. He understands that trust and reputation compound over time. Each positive interaction builds on previous ones, creating relationships that become incredibly valuable both personally and professionally. This is why Buffett famously said, It takes 20 years to build a reputation and 5 minutes to ruin it. He thinks about reputation the same way he thinks about compound interest. It's built slowly over time through consistent actions, but it can be destroyed quickly through poor decisions. Health is another area where compound thinking applies. Small daily habits, eating well, exercising regularly, getting enough sleep, don't seem important on any given day. But over years and decades, these habits compound into significant health advantages. Buffett, now in his 90s, still works full-time and maintains an active schedule, partly because he's been consistent with basic health habits for decades. The key insight here is that wealth building isn't just about money, it's about adopting a compound mindset in all areas of life. When you start thinking long-term and focusing on consistent, daily improvements, everything gets better over time. Let's bring everything together into a practical system you can implement starting today. This is your Warren Buffett-inspired wealth-building blueprint. Step 1. Set up your automatic investment system. Open an account with a low-cost brokerage. Choose an S&P 500 index fund with an expense ratio below 0.1%. Set up automatic monthly investments for a fixed amount start with whatever you can afford, even if it's just $50 per month. The key is to start and be consistent. Step 2. Optimize your spending using the needs, wants, and self-investment framework. Track your expenses for 1 month, then categorize everything. Reduce your wants spending by 25 to 50% and redirect that money to investments. Use the remaining wants spending more intentionally. Step 3. Increase your earning power through continuous learning. Dedicate at least 1 hour per day to learning skills that make you more valuable. Read books, take courses, find mentors. Focus on skills that compound over time. Step 4. Gradually increase your investment rate. Every time you get a raise, increase your automatic investment by at least half of the raise amount. This allows you to enjoy some lifestyle improvement while dramatically accelerating your wealth building. Step 5. Develop the right psychological habits. Check your investment balance infrequently, maybe once per quarter. When you do check, focus on your progress toward long-term goals, not short-term fluctuations. Think of yourself as a business owner, not a stock trader. Step 6. Create a written investment plan that includes your goals, strategy, and the circumstances under which you might change course. Review this plan annually and refer to it when emotions are running high. Step 7. Apply compound thinking to other areas of life. Build relationships consistently over time. Invest in your health with daily habits. Continuously expand your knowledge and skills. Here's what this system looks like in practice. Let's say you're 30 years old, earning $300 per month. You increase this by $1.4 million by age 65. But here's the really exciting part. If you also focus on increasing your earning power and can grow your income by 5% per year instead of 3%, and you invest half of each raise, you could have over $2.5 million by age 65. The combination of consistent investing and income growth is incredibly powerful. Once you've mastered the basics, there are several advanced strategies you can use to accelerate your wealth building while still following Buffett's principles. The first is tax optimization. Buffett is famous for saying that he pays a lower tax rate than his secretary, but he's referring to the difference between income taxes and capital gains taxes. As your wealth grows, you can use tax-advantaged accounts like 401(k)s, IRAs, and HSAs to minimize your tax burden and keep more of your money working for you. Max out your 401(k) contribution. Especially if your employer offers matching, that's free money. Use a Roth IRA for tax-free growth if you're eligible. Consider a health savings account, which offers full tax benefits, deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. The second advanced strategy is geographic arbitrage. Buffett has lived in Omaha, Nebraska his entire life. where the cost of living is much lower than in expensive cities like New York or San Francisco. You don't have to move to Nebraska, but consider whether you could maintain your income while living in a lower-cost area. The money you save on housing and living expenses can be redirected to investments. With remote work becoming more common, this strategy is more accessible than ever. If you can earn a San Francisco salary while living in a lower-cost city, you can dramatically accelerate your wealth building. The third strategy is what Buffett calls buying dollar bills for 50 cents. This means looking for investments that are trading below their intrinsic value. For beginners, this usually means continuing to invest during market downturns when everyone else is selling. Market crashes and recessions are actually opportunities for long-term investors. When the market drops 20%, 30%, or even 50%, you're essentially buying the same businesses at a huge discount. Buffett has said that he hopes for a major market crash every few years because it gives him the opportunity to buy great businesses at bargain prices. The fourth advanced strategy is building multiple income streams. While Buffett made most of his money through investing, he also built income through his businesses, real estate, and other ventures. As your wealth grows, consider ways to generate passive income through rental properties, dividend-paying stocks, or creating intellectual property. However, be careful not to get distracted from your core wealth-building strategy. These should be additions to your systematic investing approach, not replacements for it. Here's the bottom line. Warren Buffett's approach to building wealth isn't exciting. It isn't fast, and it won't make you rich overnight. But it works. It's worked for Buffett for over 60 years. It's worked for millions of other investors, and it can work for you. The boring truth about getting rich slowly is that it's actually the most reliable path to wealth that exists. While others are chasing get-rich-quick schemes and losing money on speculative investments, you can be quietly building a fortune through consistent, disciplined investing. Remember the three key principles. Harness the power of compound interest through time and consistency. Invest in low-cost index funds that track the broad market and develop the habits and mindset of a long-term wealth builder. Start today. Not tomorrow, not next week, not when you have more money or more knowledge. Open that investment account, set up that automatic transfer, and begin your journey to financial independence. Your future self will thank you for taking action today. If this video helped you understand Warren Buffett's wealth-building approach, hit that like button and subscribe for more content on building wealth and achieving financial independence. In the comments below, let me know what your biggest takeaway was and what action you're going to take first. And remember, the best time to plant a tree was 20 years ago. The second best time is today. Start building your wealth today and let compound interest work its magic over time. That's how you get rich slowly and surely.